Hey there, welcome back to our channel. Today, we're diving into the world of investing and taking a closer look at how the legendary Warren Buffett analyzes companies before making investment decisions. So, if you're ready to learn from one of the greatest minds in the financial world, let's get started. Number 1, understanding the business. When Warren Buffett looks at a potential investment, he really does this homework to understand everything about the business. He studies the ins and outs of how the company operates, the industry it competes in, and what unique advantages it has over rivals. By really digging into the nitty-gritty details of the business model and where the company stands in its market, Buffett gets a rock-solid grasp of how it makes money and its prospects for success over the long run. For example, when deciding to invest in Coca-Cola in the late 1980s, Buffett studied things like Coke's bottling and distribution process, the competitive beverage industry, including Pepsi and other soft drinks, Coke's brand recognition and marketing advantages. By learning how Coke operated and its strong market position, Buffett saw its potential for long-term growth. His $1 billion investment in 1988 has now grown to over $20 billion. Number 2, evaluating the management team. Buffett really focuses on who's running the show at a company. He wants leaders who are smart, ethical, and good at their jobs. For example, when Buffett invested billions in Bank of America in 2011, a big factor was his confidence in CEO Brian Moynihan. Buffett saw Brian as an able leader who could guide the bank through tough times after the financial crisis. Buffett believes great leaders shape a company's whole future. With strong leader, a business can adapt to challenges and keep succeeding long-term. But weak leadership can drag any good company down. That's why Buffett studies management so hard before buying shares. He only invests where he trusts the executives in charge to make the business thrive for years to come. For Buffett, leadership is everything. Number 3, assessing the moat. Buffett likes to invest in companies that have a moat around them to block competitors. So what does he mean by that? A moat represents the special things about a company that give it an advantage over others in the industry. For example, the powerful brand recognition of Coca-Cola makes it stand apart from other soda makers. This brand moat helps Coke stay on top. Other moats can be things like low costs, patents, or high customer loyalty. Any edge that gives a company protection against competitors. Buffett looks for moats that are sustainable, durable strengths that won't easily go away. Companies with strong, lasting moats can more easily hold their market position and keep profits up. The wider and more solid the moat, the better for Buffett. He wants big competitive advantages that allow companies to keep succeeding for many years to come. In number 4, analyzing financial performance. Buffett digs deep into the financials before investing. He carefully studies the company's financial statements, income, cash flow, balance sheet, ROE, and ROIC. So what's he look for? He looks for consistent earnings growth over the years, lots of cash flow, and not too much debt. For example, when Buffett invested in Apple, he liked that it had a strong cash position and little debt. This financial health meant Apple could keep innovating for the future, even in downturns. By assessing metrics like earnings trends, cash levels, and debt load, Buffett gauges the company's stability. He wants to see that the company can keep operating smoothly and creating value, even during tough economies. The financials offer clues about the long-term strength. The numbers help him see how profitable and resilient a company truly is before he commits capital. Number 5, valuing the company. To decide what a company is really worth, Buffett estimates its future cash flow. He projects how much cash the business will generate way out into the future. Then he discounts those future cash flows back to what they would be worth today. This gives him the intrinsic value of the company. For example, when Buffett bought Coca-Cola stock in the late 1980s, he likely valued the future cash flows from Coke's brand and global growth. Buffett compares this intrinsic value to the company's current stock market price. If the market price is much lower than his estimated intrinsic value, it's likely a good deal. This was the case with Coca-Cola. Buffett saw incredible growth potential that not yet reflected in Coke's cheap stock price at that time. Buying shares was like buying dollar bills for 50 cents each. So valuing future cash flows helps Buffett identify great long-term investments trading at discounts today. The intrinsic value reveals bargains. In conclusion, Warren Buffett's approach to analyzing companies is a well-balanced combination of understanding the business, evaluating management, assessing competitive advantage, analyzing financial performance, and valuing the company. By following these principles, Buffett has been able to make successful long-term investments and build a tremendous fortune. That's all for today's video. If you found this information valuable, don't forget to like and subscribe to our channel for more insightful financial content.